Hello, this is Bill Scheid from Applied Finance Research, and in this video we're going to look at backtest results for one of the momentum-based monthly asset allocation systems that we teach in our courses, and we'll also be looking at how the addition of the optional volatility stops and shorts impacts the results. And I want to stress here that the system we're going to be looking at is just one example configuration of our monthly asset allocation systems. This one happens to be one that I personally trade, but by no means is this the only configuration of the momentum systems, and certainly these are not the only results that are possible. I built this particular configuration to meet my personal trading objectives, but all of the systems we teach are highly flexible and can be easily customized so that they meet your objectives. So yes, we do cover this specific configuration of the system in our course, but more importantly, we teach students how they can modify and build their own configurations. So let's jump into the results of this particular system. So we have here results that were generated by a backtest from etfreplay.com and further crunched in Excel. The numbers we're looking at go from December of 2007 to July of 2023. So we have the subprime mortgage crisis, the COVID crash of 2020, and everything in between. One note about the maximum drawdown data we're going to be looking at in this video is that the maximum drawdown for the volatility stops and shorts data is calculated on a month-end basis, and the momentum and SPY drawdowns are calculated on a daily basis. So it's not exactly apples to apples, but it is enough to give us some insight for our purposes here. So the first column is the return for the S&P 500 for this backtest period. So we have a return of 323% on a maximum drawdown of 52.3, compounded annual growth rate of 9.7. That gives us a return to drawdown ratio of 6.2. And this is the ending balance of a hypothetical account that starts with $100,000 and is assumed to grow at the given compounded annual growth rate for 16 years. So that's 2008 through 2023. Next, we have the momentum system with its kind of standard out-of-the-box rule set. No volatility stops, no shorts. Here we see that the total return jumps to 693. The maximum drawdown is reduced to minus 34. Compounded annual growth rate jumps to 14.2, return to drawdown ratio jumps to 20.2, and our ending balance is now 838,000 instead of 427. Now when we add the volatility stops and shorts, we get another big increase in performance. Now our total return has gone from 323 to 693 to 960. Our maximum drawdown is cut roughly in half from the regular system. Now we're down to 15.7. The compounded annual growth rate is 16.4. The return to drawdown ratio, now we're at 10 times the return to drawdown ratio of the S&P 500. We're at 61.1, and our ending balance is 1.14 million. So we can see a really nice improvement, a big improvement in results as we go across the columns here. Next, I'd like to take a look at year-by-year results. So in the light blue columns here, we have total return percent, and we have it for the S&P for the classic out-of-the-box rule set for momentum, and then volatility stops and shorts. And then over here, we have the maximum drawdown figures, again, S&P, classic rule set, and then with the addition of volatility stops and shorts. Now, for me personally, I like to look at defense first. I like to ask myself, hey, how much money can I avoid losing before I talk about how much money I can make? So starting with 2008, the year of the subprime mortgage crisis, S&P lost 36.8%, momentum system only lost 8.3%, while with the volatility stops and shorts, the system made 8.3%. The maximum drawdown for the S&P that year was 47.6%. Momentum system, only half of that, minus 23.7. And then volatility stops and shorts, we get another reduction basically in half, minus 10.2. So we see some big defense here in what was otherwise a really disastrous year for the markets. I also like to look at 2020. That was the year of the COVID crash. S&P returned 18.4%. The momentum system had a fantastic year, 87.8%. And with the addition of volatility stops and shorts, a really fantastic 108.9%. When we look at the maximum drawdowns, we can see minus 33.7 and minus 34.3. And then we have a big reduction, basically a tenth, minus 3.6. I also like to look at 2022. You may remember 2022 had the worst combined year for stocks plus bonds since the Great Depression. The S&P lost 18.2%, momentum system made 2.8%, and with volatility, stops and shorts, the system made 17%. Max drawdown for the S&P was minus 24.5%. Momentum minus 22.4%, and here we see that volatility, stops and shorts minus 8.2%. Also, just looking at our returns here, we see that for the momentum system, we only had 3 losing years, and when we add the volatility, stops and shorts, we only had 1 losing year. So really nice improvement when we add the optional volatility, stops and shorts to this configuration of momentum system. If you'd like more information on these systems, please visit us at appliedfinanceresearch.com or click any of the links below this video. Thanks for watching and happy investing.